Goldman raises its 2024 target again. This is quoting, I'm just going to quote a couple statements from the report. All right. As the gold price keeps breaking records, we formalize our gold pricing framework and flesh out the drivers of our bullish forecast that gold will rise about 10% to 3,000 by December 2025. The market is structurally higher in demand than pre-freeze levels. And we have that excerpted with much more in the post we just sent out. Goldman raises early 2025 target on 500% increase in physical demand. It's probably more than that, but that's what we see in the London math.
Goldman Sachs has recently raised its gold price target, forecasting a 10% increase to $3,000 per ounce by December 2025. Financial trader Vince Lanci explains that this projection is based on a refined analytical model that considers recent trends and the key factors driving gold's price rise. Despite heightened volatility, the gold market remains resilient, with buyers stepping in at each dip. Lanci highlights the importance of upcoming non-farm payroll data, which could impact gold's short-term fluctuations. However, the overall outlook stays positive even as prices retreat slightly in early trading. Recent bullish signals, including a previously formed flag pattern, indicate potential for continued upward momentum. Key technical levels support this optimism, with the $2,700 level as a significant support point and the 50-day exponential moving average at around $2,630 reinforcing this foundation. The market's recent climb to $2,800 and potentially beyond to $3,000 reflects a solid upward trend, strengthened by geopolitical tensions and increased central bank activity. Central banks worldwide have accelerated their gold purchases while also lowering interest rates, enhancing gold's appeal as a safe haven asset during uncertain times. By bolstering their reserves, central banks provide stability to gold's role as a store of value, aligning with Lanci's observation that more investors are drawn to gold for its secure, safe haven properties and potential for gains. Stay tuned for more expert insights. Subscribe and turn on notifications to stay informed. Your support is appreciated.
Goldman raises its 2024 target again. This is quoting, I'm just going to quote a couple statements from the report. All right. As the gold price keeps breaking records, we formalize our gold pricing framework and flesh out the drivers of our bullish forecast that gold will rise about 10% to 3,000 by December 2025. In the report, they put out a report about a month ago. And in that report, along with other information, they shared their methodology for recommending or not recommending gold. You may recall over the last 6 months, we've been saying banks are readjusting how they value gold so that they can actually make clean recommendations. Because let's face it, if your model says gold is not a buy if rates are up, then and gold keeps going up, you have to look at things. And so they all started in one way or another, including the physical demand, lessening the financial aspect and including the physical demand. Now, the financial aspect remains intact, which is what Goldman says here, but it's been reset at a higher level. And in doing that, Goldman's version, which is, I think, by far, they've shared the most with us. Let's put it that way. Not everything, but they've shared the most with us. They divide the three main cohorts or buyers of gold into three categories. There are financial and monetary authorities who are buying it because of fear. This is like their parentheses phrase. Investors who are buying it because of interest rates, and speculators who are buying it for a safe haven. You can look at those reasons for gold to be bought or not bought, and you'd be essentially right. We tend to look at them a little bit differently. Financial and monetary authorities, those are central banks. And central banks are buying it to de-dollarize. They're buying it to de-dollarize and are owning it. They're owning gold. They're not buying it to sell it. Investors who are driven by interest rates correctly are ETF driven, and ETFs rent physical gold. You follow? They may say that they're owning physical gold, but Western investors can be very fickle. And then there's speculators who are seeking a safe haven. Well, yeah, they are seeking a safe haven. What they are doing is they're trying to make money, and they recognize that the rest of the world, number one, the people up top under the financial monetary authorities, they're de-dollarizing. So that's what's going on. Here's the chart that they use. There's many, it doesn't show up much bigger, but this is, I'll just read it to you. The bar on the left, it's pretty obvious what's going on here. Before freezing Russia central bank assets, this was gold demand through 2022. This is monthly average, shy of 20 metric tons. Now, since February 2022, demand has shot up to over 80 metric tons per month. They believe that this number will moderate in the 30 metric ton area. They think that it's going to start trickling off, but we'll see about that.
Gold's upward momentum has continued strong this year, with prices rising by nearly a third and hitting new peaks last week. This rally has been driven by increased central bank purchases and robust safe haven demand from investors. While the overall market remains bullish, there are signs of cooling in China, the world's largest gold consumer, where record prices and economic challenges are beginning to dampen demand, especially in the jewelry sector. Recent data from the China Gold Council shows a 22% drop in gold demand in China for the third quarter of 2024 compared to last year. Jewelry demand took the biggest hit, declining by 29% to 130 tons, as high gold prices discouraged consumers already facing financial pressure due to the country's economic slowdown. Demand for gold bars and coins also dropped by 9%, reaching 69 tons, according to Bloomberg's analysis. The high costs and economic strain have created a tough environment for gold retail in China. Meanwhile, financial trader Vince Lanci points to an interesting market dynamic amid price fluctuations. When silver prices fall, significant buyers may hold back on their gold bids, creating a temporary bluffing situation. This strategy lets them wait for prices to cool before making larger purchases when gold dips again. This tactic illustrates a broader pattern where market patience prompts a cooling-off period before the next buying wave. Gold's recent highs underscore strong support from central banks and investors amid global economic uncertainty. However, as Chinese demand weakens, especially in the consumer market, the broader gold market may face a complex balance between institutional buying strength and a more cautious retail sector in key global markets. Now, back to the interview.
Let's say you just bought gold today and you're a CTA and you're long stocks. Well, what would you do? You would sell the economic aspect of precious metals. You would sell silver. You would buy gold as a hedge for your stocks and sell silver, which is also a hedge for your stocks. Forget silver for a minute. It might be easier to understand if it's copper. Dr. Copper goes down ahead of stocks. Well, you sell copper as a hedge for your stocks. Whether you agree with that or not, that's what people do. Okay? Silver is precious though. So you could sell silver against your gold. And if you're a CTA person, those partially offset each other on margin. So instead of tying up $10,000, you're tying up $7,000. So this is how these things work not all the time, but they work in moments in time. And those moments in time last usually minutes. They last longer during protracted events that we see coming. Like, go back and look at Brexit. 2016, Brexit. Gold spiked, silver did nothing. Gold spiked, silver did nothing. And then silver just took off. It was crazy because eventually you have to cover your shorts when you're playing that gold silver game. And that's what happens. I'm not saying when it's going to happen, but it happens in fits and starts. You can see now, look at this chart. You can see silver rallies, it gets smacked. Silver rallies, it gets smacked. You can see, this is not a manipulation comment. If I wanted to buy gold, me, and I had a big balance sheet, and I knew that there was buying in gold at this price, I'm not going to sell it to the buyer here. I want to entice the buyer to be more patient. The buyer still wants to buy. He's not going away. I want him to lower his bid and be more patient. I want him to say, it's not going to happen. And you can do that if silver is weaker. Now, I'm not saying they're manipulating. I'm saying if silver is weaker, then the guy who's bidding for gold says, oh, silver is weaker. I'll just be a little bit more patient. I did it all the time, meaning I would back off my bid in one when the other was weaker. And it becomes a little bit of a snowball effect. So if I'm a buyer of gold and I'm a central bank and I see silver getting smacked, what am I going to do? I'm going to say, all right, instead of buying 1,000 contracts at this price, I'll buy 500, and you back off. And that's what's happening. You may ask yourself, well, if someone's doing that to get the price of gold lower, are they manipulating? Tactically, yes, but in truth, they're taking market risk. See, I don't have a problem with this because when they did this all the time. When they did this, I would laugh and I would say, well, they're going to have to cover it sometime, right? So, it's the Roach Motel thing. They were selling silver and I wanted to buy gold. I would literally back off my gold bid saying, all right, the big boys are going to stop buying gold. So I'm not going to be the idiot at the table. The market would drop and then I would buy gold and I would probably buy a little silver because I thought they'd buy it as well. This is the game. I mean, this is bluffing a pot. This is not manipulation when you think about it. It's bluffing. Now, the difference between gold and silver, and this is where the market structure cooks us as silver people, is gold is a tier 1 asset and silver is not. Because silver is not a tier 1 asset, it's not being bought by central banks. And because it's not being bought by central banks, the bullion banks are like, okay, I'm not worried about that. I can always cover my shorts next month. But gold, they want the gold now. They're going to want the silver later, but right now they want the gold. That chart says it all.
Gold's recent rally emphasizes its enduring appeal as a safe haven asset, supported by robust central bank acquisitions and strong institutional interest. While demand in key consumer markets like China has softened somewhat, central bank backing and investor interest continue to highlight gold's value amidst global uncertainties. With evolving dynamics between institutional purchases and fluctuating retail demand, what might gold's role as a secure asset look like in the coming years? Share your thoughts in the comments if this video resonates with you. Be sure to join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a valued part of our community.